join when they can. And that works. So the whole idea today, we're lately, Trevor and I have been accumulating sort of data on sort of the Canadian, sort of the microcap landscape. So, TSX listed or TSX venture listed companies, the CSE listed venture companies, and some of the smaller ones on the TSX itself. We recently, once a year, we do a sort of a manual screen. As a matter of fact, probably 4 times a year, we do a manual screen of all the companies that are sort of sub 300, sub $200 million market caps, just to get a lay of the land of what's out there. We screen for profitability, we screen for valuations, we screen for growth and things like that. So we've got some data sets around that. I can tell you that roughly 60 of all the companies that are listed in all the 3 major markets in Canada, which of course there's thousands of them, but under $300 million market cap, we found 62 that were profitable, which kind of surprised me. That's probably less than 5% of the listings that market cap are profitable.
There is a bit of an asterisk on that, though, Paul. Right? We excluded some of the resource related business,
okay,
service companies as well.
True. Yeah. Okay. So I guess you're right. There's a few that we screened out. So these are more or less the non-resource based companies. I mean, we've got some that are service companies. We had Geodrill, I think, in there, and Foraco, and a few others that made the list. But I guess it's not a perfect list, but still, the percentage of companies that we found that were profitable as opposed to not profitable was pretty interesting. And then of that subset, that sort of 62 companies, we found 19 that were growing by more than 50%. At least their top line was growing by more than 50%. We found 6 that are growing by more than 100%. And then as far as valuations, there were 16 of these profitable companies that had a market cap of less than 10 million. Sorry, 13 that were less than 10 million. 16 of them had an enterprise value of less than 10 million. 14 of these companies had an enterprise value, EV to earnings of less than 5. So, there's clearly some cheap sort of businesses out there. It's questionable whether they're going to get cheaper or whether, their earnings are going to decline here going into any kind of recession. So that's, the markets are trying to tell you something. But, from these lists, we do this, like I said, several times a year over the course of the last 7 or 8 years, sort of playing down in the real nano-cap market and trying to stick to profitability and some form of growth. We've been able to pick off some really interesting names that have done exceedingly well over the last several years. This is actually how I found Expel 13, 14 years ago. This is how we found Sangoma very early. There's been a whole host of different businesses that we've managed to pick off very early that were these sub $10, sub $20 million market caps. And then, even recently we found Inventronics when it had I think about $1.5 million market cap. It's easily 10x that. We found Fabform this way. That had a market cap of around 2 million when we found it. I think today it's approaching 18 million. So, you make a fair bit of return by buying some of these things, and if they're profitable, obviously the risk is a little bit lower than a company that hasn't generated a profit. So there's some interesting things that you can find if you're willing to sort of do the work here. And then the other thing too that we're keeping track of, and we've brought this up a number of times in our discussions within Small Cap Discoveries, but we're finding more and more companies now down market in these sort of profitable or close to profitable businesses that are getting acquired. Last week we saw Smart Employee Benefit get announced that they're getting acquired. That's a company we've interviewed a number of times. We also had that ICPEI, an insurance company that actually, unfortunately, ranked extremely high on our cheapest with a chance list, but it got bought out before we can sort of go to publication with that list. Otherwise, that one's screened very well. But I think, this environment that we're in right now and the valuations we're seeing, so many of these little businesses, it's pretty clear to us that we're going to see more of these acquisitions because it's going to be, quite frankly, cheaper for bigger companies to buy than it is to rebuild and try to build something similar. So I think that's going to continue.
Paul, just to interject here,
Yeah.
our guests have arrived.
Right, perfect.
Harold and Julian, just want to make sure you guys know how to unmute yourselves. But before you guys dig in here, I'll just give a little background on who's joining us today. Today we've got Harold Leishman and Julian Goto from LLC Private Wealth. They're over at Canaccord Genuity or CG Wealth Management. LLC Private Wealth is a team of 9 individuals with experts focused on either large cap, conservative portfolios, or small and micro cap strategies. Both Harold and Julian are very passionate, as we all are, about small and micro cap investing. They're definitely data driven, and they manage one of the most comprehensive data sets on them of Canadian micro caps on the street. Harold is also a founding partner of the team with 30 years experience in microcap stocks, while Julian is responsible for managing and maintaining the screens and data sets, and he's been investing in microcaps since he was 13. So we've got these guys here. They're going to be they've compiled a large data set about the money flows that are kind of coming in and out of the venture market, and we'll open it up to you guys and kind of let you guys tell us about this data set, what it means, how you interpret it, and I invite you guys to unmute yourself now.
Thanks, Trevor. We've got Harold here and Julian.
Thanks for having us, guys.
Yeah, always
Welcome.
A pleasure.
Welcome. Always good to hear Harold.
Julian, do you want to go through sort of the dollar value stuff that we did? I'll mute myself so there's no echo.
For sure. So I guess, I don't know, I'll just lead it by saying that, we're obviously data junkies. And I think most of it comes from a bottom up looking at companies approach. And our kind of me and Harold's thesis was, you can pick the company correctly, but probably a large amount of returns are going to be based on kind of the ebbs and flows of the tides. And you obviously hear the adage, the rising tide floats all boats. And I think that, it's never as true as it is in small cap markets in Canada. So basically what we did is we compiled the dollar turnover, which is just the dollar value of all the stocks traded on both the venture and the CSE. So, we put that together, crunched all the data and just shows what I think is interesting is it kind of confirms what a lot of people in the small cap space are feeling, that, these things at the end of the whip, at the bottom of the ladder, as far as size, are pretty washed out. The tide is out and I kind of see it as a measure of froth. So I mean, it's interesting that, this is something that on any given month, $400 million of turnover between the two Canadian small cap exchanges, and we can get up to in excess of 10 billion when, the money flows in, whether that's a raging cannabis market or something else that, risk on and spec money's coming back in. And so something that we've seen in the data that's interesting, and maybe Harold wants to touch on it too, is that there's probably 3 or 4 occurrences besides today where we're at less of a dollar turnover monthly. And all those occurrences kind of in the last 15 years have happened before the influx of cannabis. So, even with all the cannabis trades taking place, especially on the CSE, we're at all-time lows as far as, capital flows in small cap Canadian markets. And so, our thesis is this is probably a good time to be looking at, some quality names that are, either profitable or close to it.
And guys, I mean, I think it's important to note that, I mean, if you go back historically, there's a direct correlation between volume. So when the lows that we've hit in almost every bear market is corresponded with a low in volume trading and dollar volume. And the subsequent, flip side is, most of the highs we've seen in these markets have correlated with high volume. So that's why this data is important, is when we're seeing near historical lows in volume, that's likely meaning that we're, at or near an inflection point from sort of a bottom of a market approach.
And Julian, while we don't have visuals in the Twitter space here, just it might be helpful for all the listeners, like, which years are tied to the most frothy or the least frothy, like what year had the highest volume traded and what year had the lowest. So it would be helpful for everyone there.
Before we get on to that, Trevor, it's Harold here. One thing to add, and the reason we chose the TSXV and the CSE was we sort of felt that would capture most of the volume traded. And the CSE, with the start of the cannabis market, went from basically a non-existent in terms of the percentage of the total value to it's currently around 40%. Obviously, at the height of the cannabis boom, it was significantly higher. It got up to almost 60%, 65% of total volume. So that's why we've added it together. And it gives you sort of a different view on it. If you're just looking at the venture exchange or just the CSE, it's a little limited. And in terms of the highest peak we could find in the last 15 years was in 2021. And that's when it got up past $11 billion a month in total value traded, versus 2015 it was sub 400 million. So the multiple expansion on that is tremendous, and I think what we've been feeling is moving from that extreme all-time high down to an almost all-time low has been challenging for many investors.
Yeah, and I'd be curious, and I don't have the data in front of me, but I would imagine there's more listings today than there was back in 2015. So we're dealing with lower volumes, lower dollar volumes, and sort of a higher. So it's spread out amongst more names, I would imagine, in this environment. So it's almost like more depressing that there's more names out there with less and less volume.
It's always hard to know. There's so many companies that get listed and then fall off the map, and of course, all the really good companies or the successful companies end up transitioning to the TSX or NASDAQ or Amex or whatever. So that would definitely be a moving target and another sort of interesting data point.
Mm-hmm. And the other thing, I see people often, they'll reference like the index, the TSXV index or the CSE index. And I keep thinking that's such a mistake, because just as you mentioned, when like all the good companies end up graduating and all the sort of the terrible ones sort of, they turn into zombies and then continue to depress the market. So you're never really going to get a proper valuation of sort of the livelihood or the pulse of the market by just looking at the venture index. I would argue this volume chart is better correlated to what's really going on in the markets than the actual index itself.
We think so. Yeah, that was kind of the purpose of putting it together, and we'll see if we can get it published on our website. We've got to float it through compliance and everything else, but that was sort of in our mind one of our tools for managing our own money and client money in the speculative markets is when interest is low, when the fear is high, it's a good time to be taking positions. But you also want to be aware of when you're at an all-time high, and maybe you want to be a little more prudent or a little more cautious with your approach, or a little more cash focused with your approach. Yep. It is a highly volatile chart. And there are one or two anomalies in it. There was one weird blip back in 2015 where, there was like $3 billion of debt traded on the CSE for a Canadian utility, which, you gotta, with any set of data, you got to dig into it and look at the outliers and try to figure out what's going on. But like I said, we'll see if we can get it published on our website, and certainly people can dig into it at their leisure.
And Harold, like, what is this data measurable monthly? Is it weekly? Is it annually? What does that sort of data stream look like?
For sure, Paul. It's just the monthly, so it's monthly turnover on both exchanges. And yeah, I don't know. A lot of it is probably what you'd assume, right? There's a all-time low 2008, 2009. The next low is sort of more sustained, kind of end of 2015, beginning of 2016. Brief dip 2017, and then essentially the next one is now. And as far as, not as far as like you said, I think price is an incomplete sort of measure. And it's interesting that even compared to COVID lows, we're lower today as far as what's being traded monthly, which is interesting.
Then COVID, and then so if it's monthly, then I guess the next question is, like, is there? Does it appear to be bottoming? Is it still trending down? Is it trending up? I mean, what do the last couple months look like compared to, say, mid-year or early 2022?
Yeah, I mean, you could probably make a case, like, if you look at the chart, it looks like it's bottoming here. It looks like it's bottoming here. I mean, just on also on a kind of an eyeball test, it looks like a lot of these names that were looking quite cheap a few months ago have sort of, put on a quick 20%. And so I don't know. I mean, we think it's a good time to be adding, and that's what we're doing.
Yeah. Well, I mean, anecdotally, I would agree with you. I think from what we're seeing, we're definitely seeing a stronger bid under a lot of the names we're looking at here, certainly, into the new year. But one of my questions was going to be around, I mean, how these dips, if you look at the last dip in, say, 2008, 2009, how long do these volumes tend to stay depressed when they're in this kind of phase right now?
That's actually something that we did look at. The most prolonged dip actually, I'm going to say, started in 2012. Things came off, and with the exception of that one odd blip, it actually lasted to 2016. I mean, there was some oscillations, but it went quiet for quite a while. Not at all-time lows, but kind of bottom 2/3 of the chart type thing. And I think from our perspective, that allows us to focus on companies that are outperforming. They will start, in our opinion, if you focus on the ones that are outperforming financially, but also starting to outperform the market or break away and do their own thing, is a great indicator of companies that could be successful. When the market's ripping, everything's flying, junk stories, crazy stories, cannabis stories that are burning cash or whatever. And so I think this is a great opportunity to find companies that are hitting their mark and performing, and perhaps acting independently of the market. And that's probably where you can get, better returns a little quicker.
Yeah, I would agree with you 100%. I think what my experience has been is that, when we come out of a, bad market or bear market, or the kind of market we've seen here over the last 2 years, it takes a while for investor confidence to come back. So they rarely come back into the junior market, right? They're going to come back into the dividend plays, or where they think it's safer, and the big blue chips and stuff like that. That's where they tend to allocate money. And then as their confidence grows through the years, that's when they start allocating down market, right? So I think we're just going through that normal cycle, and that's kind of, what you just said. I think I agree with 100%. There's so many smaller stocks right now and businesses that are performing really well, but there just isn't that investor confidence come down market and take advantage of these things. And it'll come, But the question is how long it takes for that market to gain strength again. And then, of course, you get into that hyper bull market right near the end, and that's where the volume comes ripping back. So I just think we're going through another normal cycle that anybody who's astute and getting the kind of data you're getting, you can build that confidence to go down market and start taking advantage of these things.
Absolutely. And just because it's the volume, the dollar value is down here, it doesn't mean that it's going to rebound tomorrow, I guess, is at the end of the day. These are still illiquid situations. And so, people need to have patience and wait for things to improve, as long as you're buying, quality businesses that are either generating cash or turning the corner to generating cash. Because it could, it could be challenging for a while, right? It's not an indication that markets are going to turn around and run away to the upside tomorrow. That's not at all what the data says.
Yeah, no, that's exactly what I would argue is just what you said. Just that I think it's going to be years before we get that sort of crazy bull market again. I think it's inevitable. It's just I think it's going to take a while before we get there, and. Again, I just go back to what the opportunity set looks like right now. And, when I remember 2013, 2014, sort of coming out of the great financial crisis, it was years before we got into a real bull market. But there were some opportunities within that time set that outperformed significantly, but then went absolutely crazy in the sort of the real microcap bull market that we saw, call it 2020 and into 2021. So I think the opportunity is certainly there, and I think you're reading it right if you think it's going to take a while before we get into a big bull market.
Mm-hmm.
Mm-hmm. Now another question I had, like usually when markets turn the way they are right now, certainly down market into the microcaps where these most of these companies are there because they need to raise money, they need to do financings. I mean, you're sort of much closer to it than I am. What's the financing landscape look like out there? Because that's a big driver of volume as well.
Well, I guess it depends on which side of the coin you're looking at. In terms of interest of people deploying capital, I think it's a pretty difficult market to raise money, for sure.
Yeah, we're not seeing a lot of IPOs.
Most of the businesses we're following don't necessarily need to raise money, but we'll see. There's a couple of things we're looking at right now where we think they may need some capital for growth, and we'll see what the appetite is. I guess it depends which end of the lens you're looking at. Most investors are pretty cautious, so I think it's a hard time to raise money.
Mm. Yeah. Okay. So part of the reason I raised the question is because I thought I was going to give you half the answer.
Did I lose you, Paul?
I'm still here. I don't know. Can anybody hear me?
Yeah, we can hear you, Paul.
Okay, good. No, the reason I bring that up is because just that. I mean, companies need money. There's a lot of companies that need money. There's very little money that's going into that sort of higher risk component. So you're seeing a lot of companies struggle. But what we're seeing right now is we're not seeing a lot of new IPOs. We're not seeing a lot of follow-on financings. That's another sign, as far as I'm concerned, the risk level or the appetite for anything that's down market or anything that has outsized risk.
Well, we were actually joking about this. Whoa, sorry, echo. We were actually joking about this the other day, Paul. Right, with all these acquisitions and a few go private transactions. It's sort of going back to that froth meter that these Harold and Julian are talking about. In the peak periods, there's a number of companies that are coming out. A new fad gets started. Maybe it's cannabis or a digital health company does well, and then there's 10, 20 sort of copycat companies that fall on that theme, and there's a bunch of new IPOs, RTOs, and go public. And here we are sitting at the bottom cycle of the market, or at least not the top, let's put it that way. And, we're joking about maybe there's going to be no companies to left, really that are investable. Because if we've whittled, this 3,500 companies down to 60 or 90 or 100 companies that are profitable and worth looking at, all of a sudden they're starting to disappear.
Mm-hmm. Yeah. Yeah.
So the life cycle of it, I just find, it's quite interesting to sort of watch the life cycle of these companies sort of come and go. And yeah.
Mm-hmm. Now, okay, so we've sort of discussed that, or come to the conclusion somewhat that this is sort of a good market to be looking at least and trying to find opportunities. Where do you see the opportunities right now? Is there specific sectors? Is there specific types of companies? I mean, you mentioned companies that are profitable or basically don't need to raise money. Where are you seeing opportunities right now?
We're sort of focused on kind of the same things as you. We're focused on companies that there's opportunities out there. They're trading for slight premiums to their cash value, and have operating businesses and make money and have catalysts in the future, and so that's principally where we're focused. We're not really into any market segment. It's really about, hey, who's got a low risk and revenue growth, which is fairly apparent, or optionality that is fairly near term. We are willing to pay a higher multiple if there is significant revenue and earnings growth that is again either readily apparent or near term. I mean, there's a couple of companies out there that have absolutely blown the top off their revenue growth, and EBITDA is just turning positive, and we think they've got tremendous runways for lots of continued growth, and that's kind of where we're putting our money and recommending to clients that they put their money because we think that will get revalued in the not too distant future. And that's the fun of speculation. Sometimes we're right, and sometimes we're not.
So, and I know the answer because I know how you work, Harold. But are you doing bottom up analysis, or are you doing top down? Do you try to find a sector and then try to find the best player in the sector? Or are you really just going from the numbers?
We're with the numbers, and so we're tracking, I guess, 90 odd companies. Well, we screen the universe, every month. We're looking for companies that are making new highs or percentage moves, and then we just consolidate. Well, we sort of get a history of their financial performance over the last, I think it's 14 quarters that we look for trends, and then relative valuations for revenues and EV to EBITDA, and really trying to capitalize on things where we can see massive earnings growth in the not too distant future. It's a sort of a mini algorithm we've got, and we're happy to. Well, I think we've shown you, and we're happy to show anybody else what we do. But it starts with who's cheapest and growing fastest.
Mm-hmm. Yeah, no, perfect.
And ideally, if you can pick up a catalyst or two for free. I mean, some of these companies are what I like to refer to as self-funding lottery tickets, right? They just keep producing shots for the big time, and they fund it with their free cash flow, and they trade for low single-digit earnings multiples. And if you have 20 of those in your portfolio, at some point you're probably going to do okay, I would think.
Mm-hmm. Yeah. Now, we've seen companies put out good news. We've seen companies, over the last little while, put out good news and not move. What it's more, I guess, a gut feel or anecdotal, but what's the lay of the market right now? Are you seeing a response to good news? Because I'd argue 6 months ago, a company could have put out whatever good news there was, and there was no reaction in the market. So are we still in that kind of market, or is it getting a little bit better?
I would say it's getting a little bit better, but only marginally. I mean, there's companies out there that are generating mountains of cash, and the price goes up, a nickel or something. It doesn't go up much, less than 10%. If you put out anything less than good, you're getting absolutely decimated. Well, actually, to be fair, I think that's already happened. Everything's been decimated already that hasn't put out less than exemplary numbers. So if and that sort of goes back to why we think if stocks are starting to outperform the market even a little bit, and there's some good results there, in a better environment, you could get a fairly significant lift. So it's getting better, but it's not been it's not frothy. Put it that way.
No, it's definitely not frothy. That's for sure. The question I'd sort of asked earlier, I don't know if I've really got the answer I was looking for, but are you finding any sectors that are performing better than others? Like, are you finding any clumps of stocks that are doing better? I mean, one thing we've noticed is a lot of the stocks that have been performing a little bit better than most are, generating cash for sure, but also companies that have NCIBs, so they're buying back their stock. Are you seeing anything out there that's of note?
I don't know. I mean, there's a number of names in, we'll call it the life science area that are probably doing a bit better, and maybe that's because they took the brunt of it earlier with the general market. We certainly look at companies that have active NCIBs as a great plus, but I wouldn't say there's anything out there that's really killing it in the market that I've seen. It's just companies performing well. Stocks are going sideways if they're doing well, and maybe going up a little bit. Yeah. Julian's whispering and said profitability definitely matters. So
yeah. I think we've almost come full circle. I think 2 years ago it was growth at all costs that was getting people excited, and now it's profit at all costs, right? If a company's not making money and runs the risk that they have to go and raise money in the near future, I think the investors are shunning those companies like crazy. But one other thing I note, and maybe you can agree, disagree, but I still think the average investor right now is still very skittish. And if they're holding one of these stocks that are, starting to bounce, I'm finding a lot of people are happy to take a 20% gain right now and run and sort of hide their cash. Where if we are at sort of the early stages of a bull market, you'd think that, a 20% move is nothing compared to what really these business can generate. Where do you see the investor psyche with, even some of these companies that are starting to kind of outperform right now?
Yeah, well, I think you're right. I think people are still in that mindset of, there's been lots of damage, and so if you have some green in your portfolio, people are inclined to act on it and say, well, at least I've got a profit, which in my view is usually short-sighted. The other thing I'd say is, clients are frustrated to the point where, like, they don't understand that this is where patience becomes an asset, right? They're looking at these things saying, hey, I've got this, and the company's performing well, and the stock market doesn't care, so this isn't a good strategy. And so it's a weird time, right? Investing is a highly emotional experience. Whether you want to accept it or not, it is true for everyone. And boredom is its own emotion.
No, that's true. Okay, so you've looked at this volume, sort of base data, dollar volume, trading volume. What other data do you rely on? What other stuff do you look for?
Well, our focus, like I said, is primarily it's all about revenue growth and earnings growth. And we do have extensive calls with management on an ongoing basis. One of the things I guess we have in our algorithm, or one of the algorithms we run, is relative performance of the stock versus the venture exchange, right? So we can rank our companies or our data set by who's cheapest, growing fastest, and on top of that, who's also outperforming the market best. And maybe that's where we want to make sure we have a position. If it's cheap and growing fast and the market's starting to respond to it, that's better than something where, the market is punishing it, even if it is cheap, right? You can get stuck in these things for a long time. Doesn't mean you don't want to own it for a long time, but you also want to focus on, returns are a question of percentage made over time. So.
Gotcha. Now, here's a tricky question, because I know you've got all sorts of compliance issues you got to deal with. But are there names we can talk about? Are there any things that we won't give buy or sell recommendations, but anything that you're seeing screening well? Any metrics around that you can talk about? Anything you feel comfortable saying there?
Yeah, I don't know how much I can get into that in a general call. I will say, there are some companies out there, like I said, and these are, to put it mildly, these are all highly speculative, high risk situations from an investing perspective. We're dealing in penny stocks, and so people should consult. But there's, you could look at a number of companies. There's a company called Cressida, as an example. It trades at a slight premium to cash. I know you're aware of it. If one of my father's favorite stories is he went to whatever the discount stores in the States for Nordstrom Rack, I guess, and he bought a shirt for $1. And when he got home, when he put on the shirt, he found $1 in the pocket. So if you can go buy a business that's trading for cash, you're kind of buying the business for free.
Yeah.
You have to ascertain whether you think there's additional upside from there, of course, or whether, what other risks there may be in the business. It's because it's never quite that straightforward, but things can get fairly simple in that perspective. And there's lots of other companies. Every company out there, even the ones making money or growing, they also have their own risks, and the employment situation right now, if the company requires lots of low wage workers, they're going to struggle probably, right? Because you can't get workers. I know, you're a director of Atlas, so you probably can't discuss it too in depth, but I mean, it's producing lots of cash and trades for low multiple. The general market view, I'm assuming, is that there's, some sort of housing crisis looming, which may or may not be. And so it trades for a low multiple, which is the right perspective. Time will tell, and people can deploy their capital as they see fit. But I don't really want to get into a whole bunch of blanket recommendations, because that will get me in trouble.
You get in trouble. Yeah. Sure. Well, I think the it's interesting, sort of the mispricing we're seeing. What I was trying to get at is that I've been doing this for 30 plus years. There are certain times within that 30 years or so that you get just crazy mispricing, where you're seeing assets that are, businesses that are trading well below their assets, in some cases well below their cash. They're profitable, growing. And you just don't see that in bull markets. You don't see the kind of valuations we're seeing on a number of these deals, even in sort of somewhat normal markets. So I don't say this is an abnormality, or certainly a lot of these things are trading well below the median or the mean historically. So if you can stomach the volatility and stomach the uncertainty right now, there's the risk reward to me certainly looks better in a lot of these assets than we usually see. The flip side is they don't move as fast as they do in a bull market. So when you buy something, you can't expect it to move the next, within hours. But certainly the values are there. Absolutely.
You got something trading for, 3, 4, 5 times earnings, and earnings are growing at 70, 80, 100, 120%. Like it won't take long for the valuation to get sillier than it is now. And the volatility is really more a question of the illiquidity in the market, right? So because there's no stock trading, something can trade from 70 cents to 50 cents on virtually $10,000 of stock. And percentage wise, obviously that feels like a lot, but it is just that illiquidity manifesting as volatility. So
Yeah.
it
Now,
is a time
yeah.
for courage.
Yeah. Oh, for sure. The other thing that we talk about for a bit is sort of institutional money. So much of sort of bull markets are really driven by the large pools of capital, institutions, ETFs, just larger investors. I mean, again, you've got a bit of a pulse in the market. Are you seeing anything in the way of institutional money down market in these sort of nano caps and micro caps right now?
Not so much institutionally.
Mm-hmm.
What has been new, or sort of, I'm going to call it a newer phenomenon that I think we've seen, are family offices.
Mm-hmm.
There's quite a few family offices which we talk to and have come and are looking around, and their issue is how do you get a position in some of these things, but their viewpoint is different than traditional institutional money. Traditional institutional money is pretty hot and pretty fast. They
Mm-hmm.
have to keep up with benchmarks or exceed benchmarks, and so when the market's on, they come on and they drive a ton of liquidity in, which is when you see these big spikes in volume and value in these things. And when the market's terrible, they have to blow it out. Because they can't have it on their books to underperform. The family
Mm-hmm.
office money that we've talked to, their view is we'd like to take a position and hold it for 10 years as
Mm-hmm.
long as we think it's going to outperform, because that's what family offices are for, right? Is
Mm-hmm.
preserving and growing this long-term wealth. So I would say no to institutional money currently, but there are family offices that are actively assessing lots of different opportunities in the space, and in some cases, quietly trying to soak up a meaningful position. If they can buy 9% of a company or 5% of a company that's cheap and growing fast, that could serve them well, over a longer period of time.
Mm-hmm. No, I'm seeing the exact same thing. I talked to both the institutional sort of network that I know, and then the family office network that I deal with as well. You've described it perfectly. One is run away from the the market, and the other one is now more intrigued because of the valuations, and of course their challenge is just that, is they're trying to establish a meaningful position in some of these. But I'm also noticing that some of these type of investors, these family office type organizations, they're the ones that are triggering some of these acquisitions or quasi private equity style acquisitions of these businesses. So it's interesting that they're sort of moving the way they are, but I think ultimately it's a sign of where we are in this market. These guys are typically more driven by value and opportunity and less by momentum, whereas the institutional guys are significantly more momentum-based investors.
Yeah, no, absolutely. I remember talking to one family office, and he referred to the Canadian venture markets as semi-private equity. It's like buying a
Mm-hmm.
private equity situation, and you have occasional or partial liquidity at times,
Right.
which was fine if you had the right time frame for that.
Yeah.
And family offices aren't bonused on returns like fund managers are, so they've
Mm-hmm.
got a different time frame that they're dealing with.
Mm-hmm. Yeah, no, exactly. Um, well, listen, I mean, I think I'm not sure if anybody's got any questions, but it'd be good to open up, the lines, or if anybody's got a question, maybe raise your hand, and we'll try to get Harold to answer it if we can. So feel free to think of something and fire it at us. In the meantime, Harold, what else do you have to say about these markets? What's your outlook for 2023?
I'm reasonably optimistic. Personally, I've been deploying cash into it. And with any market, you never really know what the catalyst is that will sort of get things going again. But there's enough volatility, enough things going on that I think something will light it at some point. I mean, it could be mining. Who knows? Mining's been in a long suffering funk for for ages, it feels like. Who knows, right? It's hard to it's hard to say. I think one of our other partners who manages conservative money, and he does it in a similar way as well. His platform is all about free cash flow, and that's the same way that ours is. And he's been pretty defensive all last year, and he's actively looking for moments of weakness to redeploy capital in the conservative markets. And I certainly think if you got stability in the conservative markets and a more robust stock market in general, that could be a catalyst for money to trickle down into these juniors as well. So he's currently sitting in about 25% cash. So he's got a ways to go. That's down from the 30+% cash he was in sort of late last year. So we'll see. So I think that could be something. But the biggest hurdle that my clients currently have is having the courage of their convictions and having the patience to see these things through. If you find a good opportunity, you have to trim the ones that haven't performed or sell them outright and redeploy the capital into something you think is going to be better.
Mm-hmm. Mm-hmm. In your experience, what are signs to look for that we're getting out of the funk, like that things are starting to head in the right direction?
Other than stocks going up?
That helps. I guess volume and dollar volume going up, but is there anything else to look for? I mean, one thing that we look for is like bought deal financings, for example, or an increase in IPOs. I mean, there's a whole bunch of other factors you can probably throw in there, but is there anything that you guys tend to lean on a little bit more?
No, I mean we tend to be, principally fundamentally driven. I mean, you certainly, you get a lot more promoter calls. We get lots of promoter calls in the office, which get, primarily they get screened out. But the volume of it is pretty low right now, and I'm sure somebody will come up with a hot idea, and then the phones will ring off the hook with everyone's got the latest gadget or widget or whatever it is. And then they'll get 20 calls a day from an assortment of promoters. But it's tough to say. Like I said, this dollar value measurement is sort of one of our key measures of where are we in the cycle, right? And I think if we see that start to tick up on a month-over-month basis, that might cause us to try to get more aggressive. Right. So we'll see.
Yeah. And in your opinion, what should investors stay away from? Like what is still dangerous out there right now? I mean, there's always dangers, but what's more dangerous?
Yeah, I mean, it's the reason like we're focused on companies with cash flows is, they're not forced to dilute, right? So if you're excited about a hot story, the chances are they're going to have to go to the market and continue to raise money. And currently there is no appetite to raise money. And so they are going to be either massively diluted or, in worst case, not be able to raise the money and go out of business or have to consolidate and change their business or whatever. So I think I would continue to focus on companies that are making money or about to make money, and or have significant balance sheets, if they're break even or whatever, that they can withstand a setback if it happens.
Mm-hmm. And are you guys doing anything around the resource sector? I mean, there are companies obviously that have good balance sheets and generating cash. I mean, do you guys look at resources, or do you stick to more industrials?
We stick primarily to companies with cash flow. We do have a significant resource component to our client base, just because of personal backgrounds and time spent in the Canadian markets. we don't really recommend it to clients. We do dabble personally in that space from time to time because we like to, but no, typically the resource space has been pretty tough. It's we saw a couple of companies produce some pretty exciting drill holes, and stocks went nowhere, literally nowhere. I mean, they had big intercepts, and nobody cared. Some of them have big balance sheets. It doesn't really matter, I don't think. With the resource companies, you really have to look at what the majors are doing, and then the mid tiers, and then after they move, eventually it trickles down to the juniors. But that's not really our focus. It's a little more complex than we can manage.
Yeah, no, I'm the same way. I find in the resource sector, resource stocks, especially the junior explorers, they do well when there's a raging bull market in that sector, right? Which might be 1 out of every 10 years. So you suffer 9 really tough years to try to get that 1 year, and if you're lucky and time it right, you do okay. But I've never been able to time it right. So
yeah, and you could get yourself blown out of the game.
Yeah.
Pretty easily in that space. So not where we none of them really screen terribly well for us.
Gotcha.
And you once pointed out to me the problem with the resource business is you're not really in control of your pricing.
Right. Yeah, you're price taker, not price maker.
Price taker, which makes it difficult to have forecasts and all that kind of thing. So
yeah, and most of them are constantly financing. So you're not only your price taker of whatever commodity you're dealing with, but you're price taker when it comes to raising money.
Absolutely, and you're gonna your job is to spend the money.
Yeah.
Not as fast as possible, but almost.
Yeah.
It's.
Yeah. The way it was described to me, and this is by somebody within the industry, within the mining industry, is that what a lot of promoters consider assets. These projects or these pieces of land they have are not assets or liabilities.
That's right.
You have to spend money.
You have to spend money. You got to make your property payments, everything else.
Exactly. More quote unquote assets you have, the more money you got to spend.
Yeah, exactly.
So yeah, I prefer the other way around. Well, cool. Well, what else? What else can we talk about here that we haven't covered? If we, we talked about data. We talked about sort of your ideas of where the market is right now and where it's going. What other thoughts do you think are important that investors know right now?
Yeah, well, I guess the only other I don't know if you covered it. One of the latest changes in the venture market are these new life issues. These life prospectus issues.
Right.
We did a little blurb on that recently with the securities lawyer. So that sort of changed the financing rules for small public companies.
Okay, let's get into that. Yeah, let's get into that. Describe that a little bit, because I know a lot of investors are really aware of some of the changes that are happening. I mean, everybody's probably familiar with the traditional sort of 4-month hold. These financings that are being done, but and typically you have to be an accredited investor. The exchange is really trying to change some of these rules, make it a little more democratic. Maybe describe what you're talking about here.
Yeah, so they've come up with a new process for small companies where, with call it consistent disclosure about the business, they can fairly quickly and cheaply have a form of prospectus that allows them to raise capital by issuing free trading stock or units to investors. So the rules are you can raise up to $5 million or 10% of the dollar value of their securities. Whichever is greater, up to a maximum of $10 million on a rolling 12-month period. And the people investing in it don't need to be accredited. And that's really a key piece. Private placements have always been kind of a weird thing. You could be, a 30-year-old entrepreneur making $190,000 a year and have $900,000 in cash, and you're not accredited. You could be an 80-year-old man with no income but $1 million of cash and be accredited. I mean, it's certainly not appropriate for an older person to be speculating necessarily like that if that's all of their assets. For the younger person, it may be more appropriate, right? I mean, if they're going to grow their income and grow their assets and all that sort of thing. So it's, I think, useful. And I think from the regulator's perspective, they sort of said, hey, you know, you could be that 30-year-old and you can go buy the stock in the market. We'll allow you to do that, but we won't allow you to invest in the company. And that doesn't seem fair.
Yeah.
So I think that'll be interesting. It's not, you're not allowed to do it if you're a shell company or a SPAC, and you're also not allowed to do it for what was the term they used? You know, significant acquisitions or restructuring. So you know, if you're call it a small mining company. Or a small mining company is easier, and you've got 10 million shares out, and you're gonna issue 30 million shares for a property. You know, that would be a significant acquisition. So you couldn't use it in that form because there's no history for the investors to kind of gauge where you are in the business. Right. So I think it's going to be very interesting. We'll see what the capital markets do with it. The regulators, I think, always do their best to try to come up with equitable and fair rules for people to work with. And the capital markets are intensely creative and will usually change it into something that the regulators hadn't fully anticipated. So I'm very interested to see how this plays out.
Yeah. No, I agree. You described it well.
and
they'll bend the rules as much as they can. Yeah.
Absolutely, it'll be creative. But I think it'll go a long way to making it easier to raise money for public companies. And they'll still have to give discounts. I mean, like, there's no liquidity in these things, and so you go raise, $4 million at 50 cents. Well, there's no way all that stock can trade into the low volume that a lot of these companies are showing. So they still have to have discounts or attach a warrant or half warrant to take that on. Hopefully companies are smart enough to raise enough capital. Historically, a lot of these small companies, never quite raise enough money to achieve their objectives because they're always worried about dilution, which is fair. Again, why we like companies with cash flow, because it kind of limits that. But I think if you're constantly out there raising $750,000 or $1 million, and you have to do it every 4 months, like, the stock's not going to go anywhere anyway. So
no, I think that's a big risk that a lot of investors don't really properly sort of price into things, as the financing risk or dilution risk when a company's burning money, and certainly burning money aggressively. So important thing to watch out for. Okay, well, listen, I think we passed the top of the hour here. Didn't know exactly how long we'd take this, but Harold, anything else you want to cover or say before we wrap up? Do you think you've sort of said your piece?
I think I have, and I really appreciate you inviting Julian and I onto your talk. It was great. Like I said, we'll try to get that data set on our website, and so if people want to take a look at it, they can take a look at it and come to their own conclusions. We might have to put some disclaimers in for if we've taken some bits out or smoothed some lines for our own uses. We'll try to make sure it's all detailed properly. But and we'll try to keep it updated on an ongoing basis.
Well, perfect. Well, okay. So if somebody wants more information about what you're doing and wants to get in contact with you, what's the best way to do that?
The best way, I guess, is to go to the website. And our website is llcprivatewealth.com.
Perfect. And okay, so good. So we've been speaking with Harold Leishman and Julian Godot. Guys, great to talk to you. I know we're going to catch up personally, hopefully not too far from now, but great to have you guys in here. And, hopefully we can catch up with you guys when there's another sort of change in the data that makes sense to talk about.
Perfect. Hey, thanks so much for having us. I appreciate it.
Thanks,
You got
guys.
it. And you bet. Thanks, Julian. I want to thank everybody for joining us today, and look to catch up with us again same time next week. Bye for now.